Did you happen to hear this, stock pimp? I love it. CNBC, the Contrarian News Bubble Channel. They put one of these guys on almost every other night. They're always telling you, oh yeah, we're on support, folks, and I think that's it, and then we're going to go higher. And I got some stock to sell you. Oh yeah, how about some Amazon stock? That's doing pretty good here after hours. Now, I'm going to let him speak for himself. But he points, he says, see right here, it hit that line right there. And that line is the 200-week moving average. Holy smokes! Mary, 200-week moving average. And it hit that line and it bounced up there. And so now, I think that's it. The bottom is in. The bottom is in, and we're going to go higher from here. And we're going to be buying some Pulte homes and some cyclicals, and everything is great in the market. We're off and running. It's time to put your money to work, folks. Oh, okay. And why is that? Well, let me show you. We come right down here. See, like way back here, like a bunch of months ago, and we came down and we touched the purple line. It's that commercial, follow the purple line, your retirement. So we touched it and we bounced off of it. Isn't that amazing? And so we're going to probably do that again. And look at down here. We had a little bit of penetration. That's what he says. We had a little bit of penetration and then we bounced off of it. Isn't that beautiful? And so let me jump ahead and show you another slide. Oh, no. Not so fast. But you listen to him. He disregards that. Oh, shit. You mean like we came from? Why didn't he draw the line from from here? Oh, it's a 2-week moving average. There's nothing. I love it when they draw the lines though. They love that. They're not drawing those trend lines because they just ain't quite lining up. But so now they're using, and that's funny, because they'll use whatever line the hell they can use. I mean, if they can draw a trend line, baby, they draw the trend line. If you got a moving average, if the 200 didn't work, it would be the 100-week moving average. If that didn't work, it would be the 250-week moving average. I mean, we got to, those moving averages are really, really important. Okay, there's only one problem. He didn't discuss that. Uh-oh. Look at that. See right here? It kind of like touched the 200-week moving average. You see that? It's kind of like it touched right there. And right before it touched, Mary, look at that. Like a little double top up in there. Look at this. Oh, shit, Mary. Got a little of that. Does that look like that to you? And then we came down and we hit the 200. And then we gave a little shit bounce there. See that? Right there? Maybe that's where we are right now. And then we come back down and we break the 200 moving average. Oh, crap. Oh, man. Oh, gone. But we don't even want to discuss that. Listen to him.
Very different from what we saw in the beginning of 2018. Think about this. When we came into the beginning of 18, the market was at a high, and as Karen had pointed out, it had a pretty good run into those highs. Sentiment was really high. And one of the more important parts we haven't discussed yet is that the dollar was high, or sorry, the dollar was starting to bottom. So we look at the setup now. We have the dollar relatively high and beginning to roll over. We have the S&P pulling right back to the 200-week. And while that's just a purple line on the chart, it's really important from a technical standpoint.
Oh.
We got to those December 24th lows. It was around 23.46, 23.48. That was exactly at the 200-week, not dissimilar to what we saw at the 2016 lows, and somewhat similar to what we saw at the 2011 lows. And more importantly, if you look back at the bull markets in the 1980s and 90s, and the bull market in the 1950s and 60s, that 200-week provided long-term structural support for these cyclical pullbacks. So what I think we just saw, and particularly as you start peeling the onion and look at a lot of stocks, we just saw a cyclical correction, very consistent with what looks to be, on average, a 4-year cycle. Every 3 to 4 years, we put in a major low. To be honest, I thought this low was going to happen in the back half of 2019. We put a low in 2020. I got it wrong. But it's now responding to a level that I think is really important. So let's take a look at a couple of stocks.
Oh!
We've talked about these before.
That's it. He didn't really want to discuss that 50% decline in like 3 months back in 08. Didn't even go there, folks. Why is it that, we should really back it up? Let's back it up. We can back it up. Okay, we don't have Melissa, but he can discuss that. He can discuss that. And he can discuss that. But he don't want to discuss that. Okay. I'm Bag of Don, StockMarketCaddy.com. Foolishness. Moving averages don't work. You know what? That's sophistry. Sophistry. Okay? He didn't want to point to that because that didn't work. You know? This guy has no freaking idea. And to be honest with you, I don't have any freaking idea. But I got one thing that does. The Stock Market Caddy and the Swing Machine and the Nicholas, if the market continues to go up, they'll ride it. The Nicholas is long on January 25th. If the market turns down and it's not relying on moving averages, it's going to sell off. We're going to participate either way. If you want to listen to this, by all means, it's free. It's free. Free, Mary. Turn on Cnbc. Let me get a beer and some Cheetos. Come on, folks. Get an education someplace. Good luck.